Hi guys, I just wanted to go through today a bit about what central banks are doing and how it might impact your portfolio, and why I believe central banks have actually been at the kind of a bit negligent for a while, and how that comes into play from a macroeconomic perspective on what you can expect going forwards. So just going to run through a few slides and talk over it a bit. So this is the Fed funds rate. It's what we've seen since 2000. Obviously, we had a low period since 2009, since 2016, where we've seen monetary policy really get used to its full potential. They're using it to uh, keep inflation low and keep the economy going. It's one of the tools that they've used probably more so than others. And as we'll come on to, they've got other advantages that they haven't had um, to to increase monetary or fiscal policy, and probably should have looked at this at an earlier stage. So this is just the U.S. debt level sourced from Statistica from 2000 to 2022. As you can see, it's been rising over year-on-year basis at a kind of gradual rate. Again, they haven't really done any too much to tackle this problem. It's just been let. Again, if you could say, okay, well, the US uses US dollars, it's got the reserve currency, it's kind of mirrored throughout developed countries with the EU, UK, have very similar pictures. So one thing that have allowed the US to do and keep the interest rates low has been, one is the aging demographics. It's getting older. They've now had to fight this, and they've seen it as a problem that's going to cause inflation. As you can see on the table on your left here, this is the average age of the US citizen, 38.6. Compare it to where it was in the kind of 80, 60, sorry, it was just under 30. Again, this is probably more representative of what is happening. You can see it here, it's pretty much bad editing. But this, on the second to last row, is where the retirement over 65 stands as of 2020, where it's predicted to go in 2024. This is 2000, 31, and 1980. As you can see, it's been gradually growing. Obviously, if they've got more pensioners, got less in the labour force, and therefore it's going to cause more of an economic inflation on that. And one economy that you can look to that's already kind of forward looking in this respect is Japan, and how that's coping with it, and not so well. It's had interest rates lowered quite a long time with that. The other source that we believe that a lot of central banks have been negligent is, again, the debt per GDP. Again, it's been growing per statistic. This is the US and source from macroeconomics. But the Chinese wage increase, what we've had for the last 20, 30 years, is low wage. We've had we still have it in some countries, but not to the quantity that you've had in China. Obviously, may have seen, may have even known, sorry, that companies have shifted in from the West. They're kind of manufacturing to places like China because of lower wages. Seen it in the UK, where I'm from, quite frequently. People shifted their manufacturing to factories in China to make use of this lower wage. Again, it's helped combat inflation because they've had that young working population, or not as large working population, and they've been able to outsource lower wages to China. That's helped keep inflation down for so long. So we're going to look at a boom bust cycle. These are quite common in economics. It's periods where the economy does well and it does not so well. They have to lower interest rates, and it goes through a continuous cycle. What I think changes here is that the central banks have been quite negligent with with inflation, that will be another boom bust cycle, but they have to keep it for a lot longer than what as previous cycles has been, because they've got all those macroeconomics against them this time. They've got it. They can't outsource as easily to other countries. Yes, they have low wage countries, but not in the quantity of China. And again, those wages are increasing as well. One way is automation, that they could do it. In Japan, it's happening in China somewhat as well, but reverting to automation. But again, they've still got that aging population to deal with at the same time of the rising debt levels as well. So I think it's a real problem from a macro point of view, and central bankers have definitely got their money's worth of problems to sort out, and hopefully they can justify some of their wages. And I find it ironic that most in the UK central bankers pensions are all CPI linked, so it just says something on that basis. Unemployment as well is quite low, so we've got a kind of a weird scenario right now where normally if you're heading into a recession, unemployment rate is quite high. Again, this just helps fuel the inflation fire that is going. So the only kind of, from the market's perspective, positive is there isn't really too much of a correlation between Fed fund rates and the S&P. A lot more, it could go a lot more in detail about this. This is just kind of to show that there's not too much of a correlation between the Fed fund rate and the S&P. One aspect is to look at is that the PE ratio in the S&P has been growing, and this could come down. So the UK growth rates, what can they do now? And they've taken the monetary and fiscal policies kind of right at the max. This can be mirrored in the US and just the EU as a whole, but I'm just touching on the UK to touch on a bit of their new policies that they've done with the new Prime Minister Truss that's come in, and go a bit more on the macro basis on that. So this is the gross domestic product. The year Western central banks normally have a target of 2% a year. Growth of that to keep in line with inflation. Again, they're going to find that they normally do this through two ways: monetary and fiscal policy. Again, that they can't really raise taxes right now, or if they do, people will revert and go to other places where there's low taxes. You've seen in these places like the US, people are moving, trying to renounce their citizenship of the global taxation in the UK, EU. People will just go to where there's lower taxes if they do that. So if it will, they have to kind of balance it right on that. And you see from an interest rates, they've got inflation, so they've got to raise interest rates. It's kind of sticky situation that they find themselves in. Just using economics 101. So we're staying a bit on the UK policy right now, but Truss, what she's done is cut taxes in one of the biggest reforms, or UK reforms, for the last 40 years, very Thatcher-esque, that she's done. My personal view is I think it could be good in the long term. You could argue is now the right time to do it when they've got such a big deficit and fuel crisis going on. I don't know. I definitely think in a competitive environment is good. I know a lot of people disagree with me on this and say it's not the right time. They shouldn't be favouring the rich. Trickle down economics doesn't work, etc. For me personally, I think it's a good thing. I've seen a lot of bankers, obviously because the bank is cut, but also a lot of economists state this. I'm sure it's a very divided opinion, but I think it's just one of those that have to see. For me personally, I think it's a good implementation of to use and to attract top talent. She's also seen to back the banking, the financial system of London that makes up quite a majority of the sector of the UK economy, and get that back. I think there's a lot of work to do there. For me personally, what I'd do is look more on the VC side of things and look how to get funding from kind of mid-stage VCs, as you don't see much of that in Europe, particularly the UK at all compared to the US, and as we'll go into later, where it's seen a lot more in China, and why I'm more optimistic on that as a whole. But I think it's a good sign. Potentially won't see it reciprocated straight away, and may take a few years, but hopefully the UK can become a competitive economy. And as we'll go into later, the EU's got quite a lot of challenges to face with its debt crisis right now. So I'm not saying it's a perfect time or a situation where I fully agree with it, but I do think it's competitiveness, a competitive environment for top talent needs to be implemented, and this is one of the ways to do this. Open to hear suggestions on this, because I'm sure it's quite a controversial topic. So this is talking a bit about China's IPO market. Again, we talked about the UK. I think it needs to get VCs and IPOs from kind of mid-stage, needs to get off the ground there so it can go to the IPO, more kind of $10 billion companies. Again, what we're going to come on to is the Chinese market, and why I'm quite bullish about China as a whole, not just because it's kind of, the indexes are down 20% this year or more than that. It's because you look at statistics like this, it's having the world's largest IPO. Yes, you could say that the US it's not been a great year for IPOs in the US in 2022 compared to 2021, where the US was having a lot, but it's just statistics like this that shows the companies are booming in China. The rise of China as an economic superpower, again, the statistics say it all, really. You look at it from 2002, where it was, into 2022, it's 8.1% of the world's GDP. Now it's 18.8. The US has gone from 19.8 to 15.8, and the EU has mirrored this somewhat to 19.9 to 14.8. You can see which way the tide is turning. I do think it's important to stress on certain topics. If you're looking to invest in Chinese equities, there is obviously political risk, regulatory risk that we saw last year in the education system, and etc. But without going into too much detail, because it's a topic you can spend a lot of time on, and I think it's could only touch the surface on, and fully not aware of all of China's going on. But something I would be quite confident in is that China's going to grow as an economy throughout the years. Its GDP per capita is still something like 11,000. It only needs to be 15,000 to overtake the US. That's still on the world average level, still very reasonable, and still has a long way to grow. So my argument is that normally people have 70% of their proportion weighted in US equities, normally only have 5%, even less than that sometimes, weighted in Chinese equities. Why aren't they weighted more? Again, I understand they've got political risk, but if you think of it from a macro perspective, if you think China's going to get to 20, 24, 25% of the world economy in the next 10, 20 years for a long-term investor, why aren't you 10% in it at least? That risk, I think the risk reward way outweighs on that from a macro standpoint. Again, I understand there's a lot of risks involved in China, and there's a lot of things that can happen, but it'd be hard to stay pressed with that. Again, I'm probably talking a bit too soon because it comes before the party conference in China. We'll have to see how President Xi's put out the present political situation for the next few years. I think that'd be a big key driver, but I'm sure it'd be done on growth. And also, just a quick point is that I think the current COVID situation, I think, is a problem. I think it will stagnate growth in the short to medium term, but I don't think long term it'll be too much of a problem because the CCP kind of mostly relies on has a kind of unwritten rule that it works as well as people's lives and livelihoods are growing. The debt problem as well. Again, it's a problem. I do think China and the world can overcome it because if China slows down, the world slows down. A lot of economies rely on China, so I think it can get through that personally. Is the EU on its knees? Now, this is again quite a controversial topic. One that I argue is that Greece nearly collapsed the EU, and this was 10 times less than what the debt levels of Italy and Spain presently are. You can see more far right movements. Are they good? I'll leave that to you to answer if they're good for the economy or not, the far rights. But the EU is definitely in a kind of horrible place right now. I think the last economic crisis, Germany kind of came out unweathered in 2008, was the kind of economic engine. It's not in a position to do this with the position it finds itself now with the, kind of the heating crisis, etc. And it's really not as robust. I think it's got problems of its own. It's too reliant on China. Its automotive sector probably a lot of Germans may disagree, but not as innovative as other places are. And one of its big kind of areas of growth over the last few years has been China, and China is now taking its own kind of automotive middle class section. You're going to see cars like Neo, etc., get into the Chinese markets rather than BMW. I'm sure again a lot of people disagree with me on that, but I think if you look from a technology standpoint and put that into an automotive standpoint, I think Germany's economy can be in trouble. But again, the EU's got a big debt crisis to deal with. It's got a heat and energy problems to deal with. I don't think it's a good place economically right now. I won't be too bullish on investing in the EU. So going back to investment and kind of asset allocation, are bonds back, yielding more than kind of dividends for the first time in God knows when. It's probably less. You're seeing 4.5% in corporate bonds. These are a bit outdated as well. I think it's from around about May, so it would have gone up a bit. Current increases, but yeah, the bond yields are definitely looking more yielding higher than what they have done in the last 15, 20 years. So maybe, I wouldn't say the 60-40 portfolio, but maybe 80-20 for the more conservative portfolio holder, getting something in that as well as that you've got money markets that maybe not keeping up with inflation, but again that they're yielding something higher as well. The dollar smile problems. So in economics, it's called dollar smile. When the US does well, dollar gets stronger. When it doesn't do too well, the dollar gets stronger. It's because a lot of debt has US dollars. This is going to be a problem for a lot of emerging markets, as you can see there by Reuters. It posted a lot of whole debt in US dollars. So Sri Lanka, Pakistan, other countries like Egypt seem on the brink of being hit by a kind of double case scenario with COVID, and now the strong dollar that's just making it harder for them to pay back. So this might be a particular problem if you've got investments in certain specific EM countries. Is now finally India's time. Now, I've heard this last kind of 10 years. I think it may have been said a lot before. It's blessed with good economics if you compare it to probably its closest demographic rival, China. It's a lot younger. It's also got a bit of an advantage of its English speaking. You look at where the top CEOs are. In the US, a lot of them are Indian origin. They've got a big tech sector. They've got all these positives, but it seems to be bogged down with a lot of the negatives. One is political situation. I don't think Modi's got any real challenger in government. It's got a lot of corruption in India that probably needs to be sorted. But I think if you just look here where the GDP per capita is, it's under 2,000. It's very low. If you look at that compared to China, where they were kind of almost on par, I think 20 years ago, India can definitely have that, has got a lot of room to grow. And I spoke to an Indian economist a few days ago, and he thinks that even if it gets kind of 6% over the next 10, 20 years, that's very achievable. It's not kind of what you saw in economic terms in, say, China in the late 90s, early 2000s, or Japan in the 50s, but it's a reasonable growth rate. It'll still have an economy, he thinks, of around 18 trillion. That we'll see on that. But I do think India is blessed with good demographics. It's got the potential. It needs to sort a lot of aspects out: infrastructure, corruption. Probably have a bit of a stronger political party. So Modi's got at least some challenges on that. But I do think India is a good EM market to look at. Indian equities have been quite high, but again, long term, I would be quite bullish on that. So just want to finish there and just say that it is going to be a hard time, I think, for the equity markets in the medium run. As we've going back to the slides, because of what central banks have done and their misuse, and I can't see much medium growth in equities unless they're quite disillusional to the real economy that isn't unheard of in the medium term. So for a lot of investors, I do think it's going to be quite tough that are weighted towards in equities, although in that there are certain pockets for long-term investors. Look at more emerging market areas such as China that are presently showing a bit of value, do have potentially good long-term prospects. Yes, they do have risks associated with them like any EM market, but it does have that long-term prospect. Also places like India. I think it's a good time to rethink and rediversify your portfolios as well. For the more conservative investor, look more towards bonds. If you've got a shorter time horizon, they are yielding something like TIPS or gilts that have inflation protection, maybe an option for you on that. So I hope you find this somewhat useful. If you have got any questions, feel free to message me at info@investmentforexpats.com.